Hey everyone, Sam Wiss here with Life Innovators. If you're a wholesaler, a marketer, or even a producer, have you ever been asked, how exactly do insurance companies come up with the rates that they offer on indexed annuities? Now the Fed keeps raising interest rates. They're slated to raise them another 75 basis points in September. You're probably getting calls or emails or making calls and sending emails that rates are going up. So how exactly does that process work? Now, admittedly, there's a lot that goes into it, but in this short video, I'll explain all you need to know to have an informative conversation the next time it comes up. In today's video, we're going to take a high-level look at three things when it comes to pricing fixed indexed annuities. First, what is an option? Next, how is an option budget determined by a carrier? And lastly, how does an option budget translate to the rates offered by that carrier? Stay tuned.
Let's talk about our first topic. What is an option? When purchasing an indexed annuity and selecting an indexed interest crediting strategy, the client isn't actually investing their funds directly into the index or even the underlying assets or equities that make up that index. Instead, they're simply linking their interest credits to the performance of the index, subject to certain guaranteed minimum values and non-guaranteed upside exposure. So how do life insurers provide the index-linked upside exposure? Now that's where options come into the mix. Options are market-traded instruments that give exposure to an underlying asset, in this case an index, without actually requiring an investment in the underlying asset itself. In a fixed indexed annuity, life insurers purchase options that capture the growth of the index over a specified period of time. The options equal the index-linked interest that's due to the end policyholder. This means that the life insurer's profitability is not dependent on the performance of the index because there's a match between the asset, the options, and the liability, the index-linked interest credit, in a product. But options have a cost, which leads us to our next topic, the options budget. So how is an options budget determined by a carrier? So when an annuity policy is issued, a carrier will purchase assets, typically mid-duration fixed income securities or bonds, that match the expected liability of the policy. A 10-year bond would be purchased for a 10-year FIA, for example. One of the best proxies that you can use for what these types of securities or what carrier general accounts are yielding at any given time is Moody's BAA corporate bond yield. And the current yield is 5.51%. And there's a direct correlation here between market interest rates and the yields on these types of securities. From there, the life insurer deducts a spread to cover the costs for them to do business. This spread accounts for things like acquisition expenses, carrier overhead, and the required profit margin or cost of capital. For simple math, let's assume the carrier spread is 1%. So if we take the spread and subtract it from the yield, we have 5.51% minus 1% equals 451. In a traditional fixed deferred annuity, that 4.51% would be paid out as a fixed interest credit. But in an FIA, the life insurer takes that 451 and uses it to provide index-linked exposure. We refer to the 4.51% as the options budget because it's the amount of money the life insurer has to spend on options. Now, there's other factors that come into play here and reasons why rates might vary across carriers with either a higher yield or a lower spread, which would affect the baseline option budget. Some carriers, they could have superior asset management capabilities and generate higher yields, or they could require less of an IRR, which would reduce the spread. They could also have less operational overhead for a lower spread, and all of that would translate to a higher options budget which would translate to a higher net crediting rate offered to the end client or consumer, which is what we'll talk about next. So how does an options budget translate to the rates offered by a carrier? So a carrier will go to market or to investment banks with the option budget of 451 we determined above, and they find out what kind of rates that they can offer on their indexed annuity product. And the goal is really simple: to purchase options that have the exact fair market value as the option budget. If the life insurer has 451 to spend, then it wants to buy options that cost 4.51% of the policy account value. The carrier will start by buying what's called an at-the-money call option on the S&P 500 using the budget we determined above. The current cost is 10% for an at-the-money call option on the S&P 500. However, if you remember our option budget from before of 451, this option cost for an at-the-money call option exceeds it. The carrier doesn't have enough of an option budget to provide unlimited upside potential on the S&P 500 with the 10% option cost. They only have 451. They have to limit the upside exposure for the client in order to keep the cost of the options in line with the option budget. Now, the most common way to limit upside exposure is to put a cap on the maximum interest credit. In order to do that, the carrier sells another option, one with a strike price equal to the limit, currently 109, and the net cost of the options, the one bought at the floor and sold at the cap, must be equal to the option budget. In our example, an additional option at a 109 strike price is sold for 5.49%, meaning any amount above the strike price is owed to a third counterparty. But the carrier is able to establish a cap rate at 9% based on the 451 option budget we determined originally. Any amount between 100 and 109 is a payoff made to the insurance company from the investment bank, and interest is credited to the client. Anything above 109, the payoff between 100 and 109 is made to the carrier, and the excess is paid from the insurance company to the third party who purchased the call option above 109. The client will receive their full index credit up to the cap amount. If the index is down or below the 100 strike price, the carrier lets the option expire, essentially worthless, and the client receives a zero interest credit for that term. With FIA, zero is your hero. In the end, the mechanics are pretty simple. Life insurers earn a yield on their assets, they take a margin for their profitability, and the remainder is used to purchase options that provide exposure to index-linked returns. The options must match the index-linked credits, and the cost of the options must match the life insurer's budget. This brings us back to the key question. Why do rates in FIA products change? Because there's all these moving parts. Asset yields and option prices change regularly, therefore, so should FIA rates, but not always in the way you'd expect. You've probably noticed that cap rates have nearly doubled since the beginning of the year due to rising interest rates, but participation rates have been a laggard in comparison. Why is that? In our next video, we'll discuss what influences each and why they haven't been in lockstep. Be sure to follow our page to stay up to date for any future videos. Thanks for watching.